expertise must be shared. It's not very productive when the CEO believes in active and the CIO in passive investment. And you should also know your strengths and weaknesses, because you can invest only in asset classes where you have knowledge in the fund. So in this respect, I share John when he says there needs to be a core competency in the fund. This doesn't need that you have to have the whole knowledge in-house, but you need to be able to control external asset managers. You can't do without in-house capacities. Adaptiveness to changing environment. We had 3 significant financial crises since the turn of the century, and pension funds must be able to react quickly. Now, this chart here outlines how mission and beliefs should translate into the investment process. So I have here the type of a 2-tier organization where we have a dedicated pension fund management and a governing board. The board has the task to set the mission and beliefs and to choose the government model. We believe that they are also responsible for the strategic asset allocation and the risk policy, which is a very important point to set the risk metrics correct. The investment portfolio construction, the implementation and the reporting would be the task of the pension fund management, and these parts can be partly or completely outsourced to external service providers. Now, pension funds organize themselves in very different ways. I focus here on 3 distinct models. On the left hand is the so-called hub and spokes model. In this model, the pension fund is only a nucleus which manages external providers to which nearly all investment functions are outsourced. The investment consultant usually has a key role. And this is the model that is the traditional model for especially smaller pension funds in the United Kingdom. This model is weak on control, delegation, and a lot of agency conflicts. Now, on the right hand is the integrated solution. This has become very popular with pension funds about 10 years ago after the global financial crisis. So they have the whole investment chain built in-house. They are basically an investment organization. And they compete with asset managers for talent, and the people are paid pretty competitively. This is the Canadian model. In the middle is the fiduciary investment solution. This has involved also a good 10 years ago in the Netherlands, which is the model for mid-sized portfolios. You have the core competency in the pension fund, and then you have one fiduciary manager or more to which the actual investment is outsourced. So how do we choose the governance model? Scale is, of course, very important, but it's also about the willingness to take control and responsibility and the available expertise. And I must say there is, in my view, not the one best practice model. There are only best practice factors that need to be taken into consideration. Thank you very much for your attention.
Fantastic. You are an amazingly well-behaved panel, and it's all just because of a little alarm. This is, you can make this stuff simple. Yeah, exactly. We're automating and using digital. So finally, JP, your 9 minutes, over to you.
Thank you very much, and thank you all. I'm JP Neal with Willis Towers Watson. We advise a whole variety of large retirement plan sponsors in the private sector primarily. And I appreciate the opportunity to speak to you today just about some of our experiences with those plan sponsors and perhaps some lessons learned that might have some applicability in the challenges all of you are facing. And I wanted to, what I thought might be helpful to put a framework around some of this is some results from a survey that we periodically perform, a global benefits attitude survey. This is a survey, the most recent one was 30,000 employees in 19 countries around the world around various issues related to benefits. And I've just pulled a few of the findings out of there that I thought were interesting and hopefully somewhat relevant. To start off with, we segmented the respondents into 4 categories based on perhaps what you might characterize as a metric around their financial wellness. So there was first those that were unworried, and that's a happy group to be in. Moving on to the second group, those were future worries, so they had long-term concerns around their financial resources, in particular perhaps their retirement readiness, retirement adequacy. There's those that had current worries, so they might be more focused on daily cost needs, budgeting, perhaps the cost of housing, and other daily living costs. And then there's those that we characterized as struggling, and they had both current worries and future worries. And the reason we tried to put it in this framework is, one of the issues we faced with our clients, large plan sponsors, particularly in the U.S. and in other markets around the world, is a real movement from defined benefit programs to defined contributions. It's really accelerated over the last 20 years. And one of the responses that plan sponsors often have is, well, we've shifted all this responsibility to the employees. Do we care what some of the outcomes are? And I think what we've tried to demonstrate with some of this data is, maybe they're not trying to solve some of the poverty issues that you've raised and are trying to meet in your programs, but there's other issues and reasons why they should care. So first off, we looked at correlations between their whether they were struggling and had future financial worries and their basic level of productivity, looking at absenteeism and presenteeism, and found that it was correlated with those that are financially struggling and had future financial worries. Second, we looked at just their current level of engagement in their job, and this can be highly correlated with all sorts of productivity levels. And again, we found a correlation between those that were struggling with lower levels of engagement on the job. So these were important findings, even for large U.S. Private sector employers, that maybe they might have a very high participation rate in their retirement plans, their defined contribution plans, and so forth. But there's pockets of employees out there that whether it's 10%, 20% of the population that aren't participating in the plan, and when looked together at their overall financial picture, it was having a real impact on the job. And so what this really led some of these large plan sponsors to do is to try to do something about that and try to encourage participation and engagement with the plan. One of the other things we took a look at was just the openness of employees to their employer's involvement in this. And we did find, particularly in the area of retirement benefits, healthcare benefits as well, that there was a real openness to getting support from employers, so openness to providing tools and other resources to help them out. And interestingly, when we tried to probe a little bit more on tools and other resources that might be helpful, and this is particularly relevant for plan sponsors because they need to decide whether to make some of these tools available, we did find that tools that helped with savings and retirement preparations there was very high acceptance of that, and that was, we show some cuts at the global level and around the world, and it's pretty consistent in different regions around the world. And just to sort of talk a little bit about our experience with retirement planning tools, and we have found, I think I heard earlier today that one of the real challenges is engagement with the program that you might be setting up. And really effective tools can support that and can drive that. And some of the attributes of some of the tools that we found that can really help, you hear a lot about simple. It has to be simple. One of the things that also helps with that is to be able to provide an answer very quickly. So for example, when we think about retirement readiness, one of the ways that we measure that is we project out retirement resources, we project out retirement needs, and at the point that we forecast that your retirement resources will meet your retirement needs, that's the age at which we anticipate you'll be financially able to retire. So if we can very quickly provide that result and say it's age 67 is the retirement readiness age that they might attain under their current plans that they have, their participation rates and so forth, that gives them a very quick result that might engage them. And the other, to be able to do that, we have information, the plan sponsor has information about their current rates of participation in the plan. But we also find that it's helpful to populate it with other information that might be helpful. So for example, as a plan sponsor, you might not have any idea about savings from a prior employer. But we do have population statistics on the average balances for different ages in the workforce. So if we know that somebody was hired in the middle of their career by an employer, we can make some assumptions around maybe the average balance that they might be expected to have in a separate savings or individual retirement account, and plug that in and then give them the opportunity to fine-tune that and refine that to get a more precise answer. Similar with their family composition and any sources of income from a spouse and so forth. Another thing that we find is that that can really that type of easy tool can also give them the ability to help drive some behavior as well. So not only is this engaging them in the plan and giving them a sense of control over where they are, it also gives them the ability to clearly see how the outcomes might come out. In the U.S., I think the three issues that we try to really simplify for participants in doing these types of tools that are difficult for them to evaluate. The first is the impact of taxes, which can be very complicated for different types of saving vehicles in the U.S. The second is the cost of health care in retirement. In the U.S. System, there's significant cost sharing between participants and programs they might participate in, and there's a lot of out-of-pocket costs that can grow in retirement. And then finally, there's longevity, which is very difficult for participants to evaluate. So by capturing that all and sort of under the hood in the tool and capturing a single number can help with the engagement and really capture the risk that they're facing, but give them an easy-to-use tool. So those are some of the ways that we've found to help our clients and kind of engage and get better participation in their plans, and look forward to discussions with all of you and any questions you might have.
Great, thanks very much. So that gives us a good 30 minutes for questions and discussions and panelists to amplify their presentations. So let's just go first to the floor, and then, as before, there are kind of microphones around that someone will bring to you. Or if people just want to come straight up to ask a question here, so you don't have to wait, then either one is fine. So who would, any questions? And it is true, I can't see a thing. It's the closest I'm going to get to the Oscars, I think.
It's Carlos.
Carlos, thank you. Well, now I shouldn't have looked straight at that.
Thank you. This is a question for Beth Ryan. I mean, I liked your slide, the way you presented, like, I mean, what are the challenges and what are the things that are being tried in different places. Nevertheless, I have this question regarding who is really having success, right? Because at the end of the day, developing countries have a very big informal sector everywhere. And there are some solutions that are being tried, and certainly some very interesting ones. But the numbers, right? Who is really bringing new participants into the system to save? Who is really having an effect on numbers, right? So I don't know if you have an idea on where can we start looking for those good results.
So I wish I had good numbers to be able to say. The things that I know about are not yet succeeding, I would say, and there's a lot of experimentation going on. The one thing that I know specifically about is the Mexico example, where Mexico made it possible for people to contribute at the 7-Eleven store. So that had a whole lot of the things on my list, it incorporated into it. It was making it super easy. You could do it when you had the money. You didn't have to make an extra trip. You could just do it when you were going to 7-Eleven to buy cigarettes or whatever you buy at 7-Eleven. And yet well under 1% of the available people actually contributed. And so, you know, I know a response to that is to try to do more, one response to that is to do more nudges and reminders, have an SMS dialogue with them, and I know that's what Ideas 42 is proposing, what IPA is testing, but there's no results from that at this point. And the extremely low level of uptake that indicated suggested to me that really all the solutions that have to be there are solutions that automate the process. So one thing, for example, that I think could be very interesting is that in Latin America we have the whole move to do electronic invoicing on small businesses. So this is revolutionizing the way small businesses across the continent are doing business. And even though they're still more informal, perhaps they are, you know, they're interacting more electronically and formalizing. And so, you know, that kind of a thing could be like a way in to capture contributions, just a type of example. But basically, I think we're at the beginning stages.
And if I can sort of add something on some of the work that we've done in India, it's certainly still at the beginning. But by going through and looking at each of the steps of the value chain in terms of how you're going to join. So one of the pilots we did was with a major financial institution. And they, you know, effectively they already had everything. And so there was no reason why they couldn't onboard people. And we took a bunch of business correspondents and Gautama and Parul were going round with them in terms of sort of retraining, focusing on the fact that it could be completely digital, completely paperless, that you could do the pension in 2 minutes, not the 15 or 30 that they were probably used to. And then, you know, from a low base, the increased enrollment was actually quite striking. Similar in the pilot at the kind of village level, where you go through and, you know, exactly as kind of in Beth's slides, look at all of the kind of problems and then all of what must happen, and then you see, because already there's a kind of point of sale machine in the village, which is like a micro ATM. You can open a bank account because they had the financial inclusion. The government sometimes delivers tiny payments for other programs. Suddenly, again, the person can join, and it takes them 2 minutes, and it's digital and paperless. So, and it actually works, and it's a real person enrolling in a real pension program, contributing real money. So it's not, it's a pilot, but it's actual real money, which is then being invested at scale centrally and administered centrally. So you take that individual, and again, there was a very large increase in enrollment. And the critical thing, if you then take that individual and say she moves to the city and has 4 years of formal work, if she's then enrolled into the same pension plan, it doesn't matter by whom, the national ID will link those payments into the original payments and then drops out at the labour market and then has a small business and makes some payments and then comes back to the formal later on. Or then works for a formal sector worker in the house and they can enroll them. And again, no matter how turbulent the labour market history is, which I don't think will change substantially in the next 10 to 20 years, you've managed to sort of meet the criteria, albeit it's more at the sort of the initial and pilot stage, but it is actually working, which is why you kind of think that you might have some confidence, even though obviously it's early days. Does anyone?
I have a question. Okay, actually it's not a question, it's really adding to your...
Could you just give your name, please?
Just adding to your comment in the context of what Carlos asked. So one of the things that we did in India, Carlos, was that in addition to what Will is saying, just one small change in the way contributions were being made. And this is also to Beth's point in, on what I saw in her slides. So what the government said was that no longer will we accept cash or ad hoc contributions. Contributions can now only be made through bank accounts of individuals by setting up an auto debit facility on your bank account. So all subscribers to the National Pension Scheme, when they join the program, they instruct the bank, based on their own cash flows, based on their own incomes, and so on and so forth, that I am willing to commit a payment of, say, $10, and I want to do it every month, or I want to do it every 15 days, or every quarter, right? And so I set the amount I want to contribute based on my income, and I set the frequency again based on, I could be a farmer, let's say, earning twice a year. So just by doing this and automating contributions, I think the persistency level has almost doubled in the pension scheme over the last 2 years. And this was, I think, it was made possible also partly because of an incredible effort at increasing banking penetration. So I mean, we opened, I think, close to 250 million bank accounts in 2 years under a very intense drive. But I'm just saying that we opened bank accounts, then got people who had those bank accounts to join pensions and open a pension account, use the bank accounts or the banks as a conduit to open pension accounts, made it simple, as Will is saying, using national ID, to simplify the front-end process and, reduce the overhead for banks in the way they were opening these accounts, and then automated the contributions. So I think this has had a tremendous impact, not only on persistency, but also on coverage. And
so let me ask a question from the chair. So one of the things I find most interesting about this discussion, a bit like pensions itself. So people have thought for many years, should it be public sector leading pensions or private sector? Should you have public pensions or private pensions? And the answer is you need both, plus family, plus work, plus housing. And then the same thing on the value chain, if I sort of summarize what people have said, it's not that it should be public or private, it's that people are sort of thinking about the design in a better way and saying, well, what are the requirements that the system has to have in terms of returns and costs and accessibility? And then working back in their particular country and who is best to provide it. And it may be, public sector in terms of tax administration doing the accounts, but it's private sector fund managers or the other way around. So I'm just interested in panelists sort of amplifying, maybe sort of comparing countries where they've seen something work incredibly well, but it does give good lessons for other countries, but maybe other countries chose a different option.
Well, just first thing that comes to mind for me going to payouts is the annuity markets. And in the US, I think we commonly perceive the annuity market to be quite expensive, and people don't choose annuities. I don't know that it's because they're so expensive, but that's certainly a barrier. And then my observation about Chile is that Chile actually has a very competitive, cost-efficient annuity market. I don't know that I've ever seen an explanation for why that is, why a country like Chile can have such cost-effective annuities when we can't do that in the U.S. But in the U.S., the best way to get an annuity is from Social Security or a defined benefit plan, whereas in Chile, seem to be able to do it through the private markets quite well.
I would just say that we were talking about the importance of having sort of fiduciary responsibility as the sort of the top layer within the pension fund, albeit then that there may well be commercial providers actually undertaking much of the service. And the question is then could you have a fiduciary role where it's the government taking that on? And I think, I've certainly seen examples which make me leery of having sort of the risk of political involvement in pension funds, and starting to have conflict of interest, another form of conflict of interest coming into the running of the fund. On the other hand, in the UK, we've certainly seen the British government set up Nest as a government-sponsored plan. And in Costa Rica, several of the plans are effectively, if rather indirectly, owned by the government, but seem to work fairly, in many senses, fairly effectively. So I think it does come down, the extent and nature of the involvement does come down to the culture of the country and how much it can, the government involvement, public sector involvement can be insulated from political risk. And certainly, I mean, when we get to the example of Canada, I mean, some of the most successful pension funds in the world are public sector funds. But I think if you look at the way they are actually run, the fiduciary board are not government boards. The fiduciary boards are still independent boards who just happen to be sponsored by government. So I think ultimately the trick is, as you say, it's not so much the ownership that matters, it is having a fiduciary board that actually works towards its fiduciary duties and objectives and ignores temptations to be interested in other things.
I think, may I just come in? I think the clue is to have it arm's length from the governments, because, I mean, in the US at the public pension funds, we have the fiduciary role as well, and there we have highly politicized boards, and the outcome at the moment is not really the best.
Yeah, no, thank you. And just as we ask Richard to ask a question, allows me to do a plug for some work that Fiona and I are doing with some big funds around the world to explain how did they develop a situation where they got to be world leading. So Canadian funds weren't always Canadian funds, if you think about it, in the sense of they used to be horribly badly run with terrible investment in non-marketable securities and very heavy political control, and then they had a kind of 20-year journey to be where they are now. Another example in Malaysia's Employees Provident Fund, which had many, many sort of seemingly terminal problems and has then gradually, step by step, gone to be very high performing. So this is also going to be some work which kind of sets out those steps. But Richard.
Yeah, Evan, I thought I had an answer to your Chilean annuity mystery, but then actually I'm not so sure I do. My initial thought was it's because they're mandatory. You know, and if they're mandatory, you have solved the adverse selection problem and you can efficiently price them. But then it occurred to me, I think maybe there's an option for phased withdrawals in Chile. So I'm not quite sure that's the answer, but maybe it's part of the answer. And also, I had an additional question related to your sort of ideal payout structure, which strikes me as eminently sensible for a mandatory pension system, but I'm wondering how well that would work, you know, for a voluntary system targeted at low-earning informal sector workers who have no other long-term savings. I mean, in the absence of state coercion, a system has to be attractive. You have to persuade people to participate, and as much as in principle I support mandatory annuitization, I'm wondering if you're not shooting yourself in the foot by requiring that in a voluntary plan.
Well, surely we have first of all, we have someone in the audience who knows the answer about Chile. I mean, I believe it is, in effect, mandatory, the annuitization.
No, there's a choice between.
Yeah, we can ask one of our resident Chileans.
Yeah.
And just before we hand over to Javier, Tom, you don't have to accept this challenge, Tom Terry, but it would also be interesting if you wanted to say a few words about the work you're doing on the microinsurance globally, internationally with the IAI, which people might not know about, but our Chilean expert.
Okay, so it's not mandatory to go to the annuity. You can choose, actually. After the accumulation phase, once you're ready to retire, you can decide either to go to an annuity or you go to retiro programado, so phase withdrawal or programmed withdrawals. And then you withdraw your money until you run out.
But you can't take a lump sum payment.
You do. You can also take a lump sum payment, but only if you have enough to cover some part. So you can choose either to take a lump sum plus some annuity or plus some programmed withdrawals. or if you don't have enough, you can choose between those two. And also something important to add to your discussion is that there's a new bidding process. That's why also the costs are lower than, I wouldn't say they're very low, but they're lower than in other places. It's because there's once you're ready to retire, then basically you tell all the companies, so here's my money, who gives me the most? And then they bid and they give you a lot of different ideas of how to deal with your money, and then you can choose. One other thing that needs to be addressed also, it's that, which I think we don't do it very well, it's that a lot of the insurance companies are also the same ones. They're vertically integrated with the AFPs or the fund managers. So that prevents, so there could be a lot and better outcomes, or more competition if those were not integrated. But the insurance companies that then they bid for the annuities are the same ones that are accumulated, that help you accumulate your money and manage your money. So there could be some actually there's room for improvement there as well.
Yeah, well, and just quickly on the second part of your question, Richard, on the variable annuity piece and whether you really wanted to compel people or force people to choose that. I think that it would be reasonable to do that in a system where people did have significant savings. I mean, that was one of the requirements for my ideal system, that if you're going to provide tax incentives to people, I would want them to take that as an annuity in some form, as a condition for getting those tax incentives. But then once you move down to the lower income levels, maybe you are going to have to provide more choice. I mean, I kind of like this idea of providing the minimum payment, this $1,000 in my example, and stretching it out so that rather than people being able to take that lump sum, they do have to take some kind of annuity. But there's perhaps some reason to provide some choice as well.
Yeah, Will, thanks. I know that this session today is not about inclusive insurance. That's another day, another topic. But I see a bridge, and someone this morning commented that the combination of micro pensions and micro insurance, that there's some synergistic effects, and it seems to come up here in the developed world. Whether the annuity markets are robust or not is a function of perhaps secondary or other important issues, but the annuity markets exist. And the question about whether annuity markets could exist in emerging economies is kind of interesting. The IAA, the International Actuarial Association, is engaged in a project right now in partnership with the IAIS, the International Association of Insurance Supervisors, to examine proportionate regulation of insurance such that these inclusive insurance and annuity markets can function in some kind of a proportionate way. And of course, to skinny down, actuaries are initially horrified at that, saying, well, you can't, just sort of slap something together and allow a contractual obligation to be subject to, minimal assurance, regulation, and solvency requirements. And so this project is sort of looking at both proportionate regulation as well as proportionate actuarial work, if there is such a thing. The need for solvency and assurance that the promises can be met becomes really critical. Any system, the moment you have a default, the moment you have a promise or a contract that's being undermined, the whole system's credibility begins to crumble. And so it's an interesting project to be able to take first world concepts that have been around for 50 or 100 years and bring them into an emergent economy, such that these same sorts of